United States and Europe have just struck a trade deal overnight that will see a 15% tariff applied to imports from Europe. Markets are looking ahead to the Fed's decision on Thursday and US jobs on Friday. That's coming up in our 5 Things in 5 Minutes on Monday, July the 28th. And then in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga reports back from a trip he took to the United States this month.
There's more opacity about the policy process, but it seems like the economy actually is dealing with things in reasonable shape.
But first, in 5 and 5 with ANZ, Donald Trump has just announced a trade deal with the European Union, which will see European imports tariffed at 15%. And the EU has agreed to spend heavily on US energy and military equipment. Markets were hopeful last week for a deal like this, which boosted European stocks. Here's ANZ Head of G3 Economics, Brian Martin.
I think the noises are positive. I think the willingness on the US to agree deals and avoid the highest level of reciprocal tariffs is evident in the trade deals that we have seen so far. So I think that optimism, whilst there is still a degree of uncertainty, is underpinning the better tone that we have seen in European equities.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and Nasdaq closed last week up 0.4% at record highs. The US 10-year Treasury yield fell 2 basis points to 4.38%. Gold fell 1.1% to $3,392 an ounce, while West Texas oil futures fell 1.3% to $65.16 a barrel. The US dollar index rose 0.3%. The Aussie dollar fell 0.4% to 65.67 US cents, and the Kiwi fell 0.2% to 60.17 US cents. And none of these markets have reacted yet to the US-Europe trade deal, which has just been announced. Number 2. ANZ economist Pansy Madhavani says markets will be focused this week on US non-farm payrolls for July, with growth of 101,000 expected for the month. That's down from growth of 147,000 in June. Initial jobless claims last week suggested the US jobs market had held up, says Pansy.
We also got the weekly initial jobless claim data, which are suggesting that the labour market remains relatively resilient. But it's worth noting that companies are largely adopting a less hiring, less firing mantra, at least for now. What's that telling us is that the third quarter has started on a solid footing for the US economy.
Number 3. ANZ senior international economist Tom Kenny is watching the fallout from the Japanese elections and its trade deal with the United States. The tariffs are hitting Japan's business confidence.
S&P Global reports that the impacts of tariffs weighed heavily on survey responses. Notably, overall business confidence with respect to the year ahead weakened in July, falling to its second lowest level since August 2020. With a favourable trade deal reached with the US, we should see an improvement in sentiment next month.
Number 4. Tom says the opposition's desire to cut Japan's consumption tax and its unhappiness with the Bank of Japan's rate hikes are a worry for markets.
Like cutting the consumption tax would be quite a big deal because it's an important source of revenue for the Japanese government. And if we do make that change, it'll be a structural deterioration in the overall budgetary position. So they'll probably have to look at other areas where they might be able to raise revenue or cut expenditure to offset that if they do go forward with the cut in the consumption tax. And what we also know with the opposition parties is that they weren't happy with the pace at which the Bank of Japan was normalising policy.
Number 5. There's some good news for farmers in New Zealand, as ANZ New Zealand Chief Economist Sharon Zollner reports.
So the global dairy trade index is up 16.5% versus a year ago. It's off its peak, but still looking pretty good for our exporters, if not our consumers of dairy products, of course. There's always winners and losers with any sort of price movement.
Sharon Zollner there. Now, in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga reports back from a trip he took to the United States this month.
The economy, I have to admit, was better than I thought. I still think the US is slowing, but maybe outside, I don't know whether chaos is too strong a term, but it's felt a bit chaotic. I didn't get that sense inside. Certainly there's more opacity about the policy process, but it seems like the economy actually is dealing with things in reasonable shape, but also some, I guess, more, if you like, structural issues. Strategic competition with China, a very substantial talking point, literally arose in every policy conversation. I mean, I think you can see it in the way tariffs are being faced into, but certainly conformational. It also seems to me the way this administration is approaching the bureaucracy is being extended to the Federal Reserve. They're keen for the executive branch to have some influence over policy, more perhaps than we've been used to in the last few decades. So I think the kind of technocratic Federal Reserve the last couple of decades is fading from view.
Yeah, I mean, what does a non-technocratic Fed look like, do you think?
Look, firstly, I think maybe I would discourage people from saying, well, the Fed's either independent or not independent. I think there are some shades in there which it seems like we're going to be making assessments about. Look, it may be a Federal Reserve, perhaps, which doesn't have all the responsibilities it might have today. Consider bank supervision, for instance, hasn't always sat with the Fed. It could sit somewhere else. The Fed, over time, may be more interested in how difficult or not it is for the Treasury to issue the bonds they have. You know, during periods, the Fed's done an Operation Twist, for instance, to buy long-term bonds and sell short-term bonds. It's not QE, but potentially it smooths the functioning of the bond market, which, you know, may well be required given the fiscal trajectory for the US. Maybe the voting pattern on the FOMC changes where more of the regional Fed representatives are eligible to vote. I think there's a whole lot of potential issues kind of in play, if you like, that might be different from the way the Fed's interacted with the rest of policy over the last couple of decades.
And do you have a sense of whether these tariffs, which obviously are connected to the current US president, whether they can last?
Look, it is a bit of an educated guess on my part, but I do feel that the fiscal issues in the US are going to keep rising in prominence. That means sources of revenue will be pretty precious. $200 to $300 billion a year of tariff revenue, which may have grown even more by the time the next presidential election comes around. I think that's going to be difficult for any administration to give up, given they will already have a fiscal challenge. So my estimation would be they're likely to be permanent.
And just thinking about that strategic competition with China, how, again, robust is that to the political cycles?
Well, history, I think, already tells us something about that. Trump, in his first term, introduced tariffs against China. Most of that was effectively circumvented through trade with other economies, Mexico, Vietnam, and some others. Biden didn't shift the US's stance toward China when he came into office after that. In fact, he extended it to look at industry policy, to look at controls over chips, to look at a range of other areas. I think this strategic competition with China, the US perspective of it, may well change form with the new administration, but it does seem like it's baked in the cave.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, July the 28th. Catch you tomorrow with market reaction and analysis of the big European-US trade deal just signed. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.